Well, let me come back to here. What is not shown is the commission, I'm guessing about 1 cent per share for a total of $1. Okay, it could be higher, it could be lower. Notice the title change, Engineering, Financial Engineering, Part 1. Back in 2014, I did a survey of all these financial data mining type papers, and I looked at about 48 different papers. I used Google Scholar to decide which ones to review that had high citation counts for these papers, so they're just not offbeat papers. And what I observed in the papers, that there were quite a few that did not use any stops. Okay, that's a dangerous approach, but it wasn't realistic, shall I say. Other papers of the 48 ignored commission, the 1 cent commission. Now, it might not sound like a lot, but if you're ignoring commissions and building these mathematical models, you're going to be deceptively higher than you actually would if you go from research to actual practice. Along the lines, there were several other things that had occurred. Question?
I had a question about the stop loss order. Do you base it on the annual or monthly volatility of the asset? Because if it's too close, if it dips down a little, it will automatically close the order?
Okay, the context that I use both personally and in a class I teach called Financial Data Mining is the S&P E-minis. And I've been using a default of about five points. It seems to work out well. Of course, you could tweak it and try lower and upper values to see if there's something that would optimize it. But in terms of some of the problems I've seen, one is statistical success does not equal financial success. And I'll be going over these here in a second. Small sample size, trading strategy was aligned with the market movement, scalability issues are not addressed, and there's no focus on what's called black swans, and I'll explain what that means in a moment. So statistical success not equal to financial success. One paper said, oh, my model had 55% winners. Okay? Well, that sounds pretty good. However, if the 55% winners make $1 each and the losers lose $10 each, you're going to be out money. And so there was it ignored expected value in this particular problem, and I don't think that was very realistic. Sample size, 1/3 of the papers use 1,000 samples or less. For the financial data mining class I teach, students have 66,000 samples of data. And if you're eventually going to want to go from theory to practice, it is real important to use lots of sample data, which gives you a lot of different scenarios in the market. Here's a case, trading strategy aligned with the market. The Dow going over, so many years back. I highlighted in yellow. You see, if you bought here and sold there, you do quite well, right? Mm-hmm. The idea is that if you build a model to go long, it's hard not to succeed. And the expression, even a blind squirrel finds an acorn, you might succeed in this particular case. Scalability issues not addressed. Here's an example of a model that went from 100,000 up to about 3 million. Looks pretty good, right? But notice from this point forward, it flatlined, right? And what happened was, it flatlined because the model imposed a limit on the number of contracts you can buy, 500 contracts. And so after a while, it was locked in at 500, always trading 500, so it didn't show any improvement in the modeling process. Now, if you take the same model, instead of 500 contracts, do 5,000, you see all this volatility being introduced. And you see, for example, the peak was 32 million and the bottom 16 million, so you lost half your money. Wow, I only have 16 million. I wish I had that.
And your contract is 100 shares?
S&P E-mini contract is just one S&P E-mini contract. And it goes up in value. If it goes up a point, you make $50. Goes down a point, you lose $50. There's also margin requirements, which I did not address here. That's been all over the map for the last several years. So a paper you read 10 years ago might have a low margin requirements. Nowadays, they raise margin requirements quite a lot. And it could vary from your retirement account to a cash account. No black swans. Black swans actually exist. Normally, swans are white in color. And the idea of a black swan is that it is a rare event. So in this particular case, by rare events in the context of the stock market, there have been days when the market just, the bottom falls out, loses a lot of money. And I've sorted, last 30 years, the top 10 worst days by percentages. And you see, like in 2008, there were major losses. That's when the market lost 16% in 1 month. Here you see May 6, 2010 lost 8.7%. That was called the flash crash. So the idea is, if you're going to build a robust model, you need to have data that at least walks over some of these black swans. Otherwise, you know, you might be underestimating, overestimating capability. So, coming back, this was response number 2. General approach, not sure, let me see. This was in the context of the research of academia at this point. Well, my observation is about 95 to 98% of these approaches are seriously flawed, which means I would never put money into those approaches. There was a lack of information, they make some incorrect assumptions. And so of the 47 papers, I'd say, or 48 papers, 46 or 47 had one or more of these flaws that I just mentioned. And so the conclusion is no. Based on the research, I would not put any money in that. Catherine?
Gary, when you did your literature review, how did you control for the market data they were using? Like you have the S&P and the NASDAQ, and there's a few others out there, and one that has all American stocks. So does that make a difference? It would seem like it would, versus like the CAC or the, you know.
These were papers from all over the world. Sometimes they used the Malaysian stock market.
So actually it could have, that tends to be irrelevant then. Okay.
Yeah. Other question? Yeah. So, both first 2 responses, no and no. Well, let me talk about my approach. I'm not sure. Let me see. So, first of all, let me talk about lessons I've learned from all these other papers. One of which is that you want to use lots of data, and I use about 40,000 samples per year, 5-minute data, you can figure it out. Lots of years, 17 years worth of data that includes several black swans in the process. Test all types of markets, the market going up, down, sideways, and reset. So I might have a portfolio starting with $100,000. How does it do in 1982? How does it do in 1983? So each year I reset it back to $100,000. That kind of handles the resizing issue. I include commissions, and round trip for an E-mini is 202 or 404 if you go round trip, 202 each way. I misstated that, should be 404. Money management, 5-point stops. Trade no more than 20% of the equity, because you don't, if you got $100,000 and you could buy 34 contracts, you don't want to go all in because you run the risk of, you know, getting wiped out. Okay? Other things, in terms of statistical and financial assessment, there's what's called the net, obviously net profit, how much you make per second. The Sharpe ratio, which looks at the, I think, profit divided by the standard deviation. Site question?
Yeah, the stocks, you put them no more only, or you put them also, I'm not sure.
Okay, well, if you go long, you put it underneath. If you're going short, you put it above. Okay? So that's kind of the Sharpe ratio. Max drawdown. Different people have different investment goals. If I was 20-something years old and I had 20,000, I want to try and grow it to maybe 200,000. If I'm 60 years old and I've got 800 million or $100 million, I don't want to lose 80 of those 100 million. Okay, so if I make 1 or 2 millions, I'm happy. So max drawdown is, sometimes you can assess models by how much they don't lose. So if you think of a sports team, this is the offense, how many runs they score, points. This is the defense, how much they give up. And so if you don't give up much, and you make a little, you can have a winning team. Right? Well, as I said before, there are over 1 trillion different permutations to buy, 1 trillion permutations to sell. A lot of space. So one of the things we want to do is look at how you can reduce that space and try to make the problem more manageable. And so to do that, we want to reduce the terrain. Well, first of all, you take these technical indicators and you put them in 3 different groups. The first group I call overlays, and they go on top of the graph. And so I have each of these is a bar, open, high, low, close. The open is the price at the beginning, the close is the price at the end of that particular period. The high was the highest price, the low is the lowest price. And so off of usually the close, we build like moving averages, and the green bars are Bollinger Bands, which are standard deviations. And you can have an exponential moving average, simple moving average, weighted moving average, Bollinger Bands, rate of change, which is not shown. And the price here is about $2,000, okay? So these indicators are in the 1900 to 2100 range at this point, based on the S&P E-mini. Another group of indicators is separate from the price chart, and it has specific lower and upper bounds. Now, they're not shown here, but the lower bound, this is an example of stochastics, lower bound is 0, the upper bound is 100. If I showed the RSI, relative strength index, lower bound 0, upper bound 100. Now, you really couldn't compare this to like a moving average, because here it ranges between 0 and 100, moving average is like 2,000, and if you say, well, if one crosses over to buy, if the other crosses over to sell, that'll never happen, because they're just in 2 different areas. And finally, here's an example of a separate indicator. It's not on the price chart, and it has no real upper bound or no lower bound. And this example I'm showing here is the MACD, which in this case is going from -40 up to 40. And another example not shown is called the Commodity Channel Index, CCI. So we have 3 types of indicators. We've got the ones that overlay here, the ones with upper and lower bounds shown in green, and the ones here that have no bounds. And really none of these 3 groups would intersect each other. And so by separating them out, you can dramatically reduce the search space quite a lot. Now another way to reduce the search space, that's hard to say, is you eliminate those indicators that are highly correlated. So exponential moving average, simple moving average, weighted moving average, they're more or less the same. You can eliminate some of those. So that too reduces the search space. Well, what I want to show, this is things go on before you apply any machine learning. There's quite a few machine learners available. I want to focus on genetic programs. They seem to work best for using financial data.